Oh, welcome back to Strongman Personal Finance. This is a paid video where I'm going to do a stunk analysis of Spotify. Now, the guy that paid me, I know you wanted a comparison of Spotify to Netflix, and that's going to happen, but I'm going to do it in two separate videos, one on Spotify and one on Netflix. So I'll be sending you a bill for another $50. I'm just kidding, but there will be two videos. So let's go ahead and look into Spotify. Now, I'm very bullish on this stock. Do you want to know why? Look at my screen. Do you see this? You may not be able to see it that well. Let me go ahead and pull up this screen. Do you see this? I have Spotify. That's right, ladies and gentlemen. I love Spotify. I pay for it monthly. I got it when I was a student, and I guess they keep charging me the student rate or something. But I have it, so I'm bullish on it. I mean, I click on buttons and it plays music, and it's the future, bro. Let me tell you what I actually think about Spotify without even looking at the financial statements. This is one of those investments where if I wanted to find a company with like a solid moat, a dominant company that was going to destroy all its competitors, I wouldn't necessarily invest in a company that has an ungodly amount of competition. So if you Google the global music streaming market, this is from Q2 of 2022. Okay, I'm not going to pay for like research, okay, but I trust this is accurate. It actually is, and I'll show you why. Look at the market, okay? So right now we can see on the left we have subscription revenue by source, by platform. So we have Spotify with by far the most subscription revenue in Q2 of 2022, followed by Apple Music. You ever heard of Apple? Followed by Amazon. You ever heard of Amazon? Followed by Google, YouTube Music. Ever heard of Google before? Followed by Tencent. That's Chinese. Oh my God. It's not an American stock. Bruh, bruh. And so on, so on. Melon, Pandora, Deezer. I don't know what D's nuts. But if you look at the market, this thing is saturated with a ton of competition, okay? What is the moat of Spotify? What is the uniqueness of Spotify? How does Spotify stand out from Apple Music, Amazon Music, blah, 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 blah? I don't see it. Okay, I think Spotify has a first mover advantage, and I use Spotify just because that's what I've had. But if Apple came out and said, hey, we'll charge you $3 less and you get more music per month, okay, I'll switch to Apple. Like, I'm not loyal to Spotify. It's just a way for me to stream music. But I am a paid subscriber, so that makes me hypocritical, right? But there's a massive amount of competition. I personally don't think Spotify has a moat, personally. But they have Joe Rogan, bro. Okay, if that's their moat, that's their moat. But I don't see how this business can really distinguish itself from other businesses when you basically get the same freaking thing, okay? I can go watch Joe Rogan on YouTube. Now, if you look at some of the statistics for how fast this market's going to grow, there's obviously going to be growth. Now, here it says there's going to be an annual CAGR for music streaming revenue of 5.13%. I don't know if that's true or not. This could be total BS. This could be some random clown making estimates. But there is going to be growth in this market. But it's not like insane, massive growth. Like streaming music is not a new concept. Almost streaming music. Wow. So that's my initial thoughts. Now let's go look at Stunkify, the company. It's got a market cap of $30 billion, trailing 12-month revenue of $13 billion. Net income of negative $854 million. Negative earnings per share. Forward PE of 243. Forward PE of 243. When I see that, if I saw that, I would say, okay, this has to be an insanely fast-growing company, number one. Or number two, they're expected to have low profits in the next year for whatever reason. But maybe that's not going to be something that continues into the future. A forward PE of 243 is really high. Okay, this is more of a gamble growth stock, basically, is how I would think about it. But you look at it, okay, it's gone from $69 to $160. It's got a beta of 1.76, so it's going to be fluctuating more than the market. And it's got a price target of 152 because you can trust the analysts, okay? But we all know what Spotify does. Basically, they provide music streaming and podcast on their app. And how they make money is they charge for subscription fees, and they have a little bit of ads that they a little bit of ad revenue, but it's mostly subscription fees. And then they have to pay royalties to the artists that are featured on their platform. So the difference between what they charge and the royalties they pay is their profit. That's basically Spotify. Okay. Oh, but you missed one thing. Whatever. So let's look at the financials. Okay. Let's look at the quarterly revenue growth rate. So revenue by revenue is growing at a pretty rapid clip. Okay. It's been growing consistently. It's slowing down a little bit, it looks like, but it's growing. So this is not an ultra mega clown stock. Okay. At least they have growing revenue. That's one positive thing. And I believe their revenue will continue to grow into the future. Spotify is a pretty popular app. Gross profit has stayed exactly the same, very stable at 25%, maybe, 26, 27%. Operating margin, negative. This company loses money all the time. All it does is lose money. Wow. Amazing. A gross profit of negative 5% or operating profit of negative 5%. That's before interest and taxes, too. Their profit margin is even slightly worse. They're basically a money-losing company. They got great revenue growth, but they lose money, and they're in a industry that's pretty highly competitive, and there's a lot of options out there. What's the moat? Joe Rogan? I mean, if you're bullish on Joe Rogan, I guess that's it. Okay, and free cash flow margin isn't very high either. I mean, like, I don't know. I don't know what to say. Balance sheet we'll look at when we look at their financial statements. Statement of cash flows. So let's look at their options. So they have operating cash flow. They have mostly positive operating cash flow. Like any other tech company, they probably have a lot of share-based compensation. There you go. Okay. And I believe that's the amounts are correlated with the stock price. It's based on the Black-Scholes model. It's how they value the options. And then what happens is the accountants expense the value of the options over the vesting period for the employees. So I assume the higher the stock price when the options are issued or given to the employees, I'm assuming that leads to a higher stock-based compensation expense. So I think over time you'd see it fluctuate, I think, based on the stock price. So stock-based compensation expense has gone up, and that may be up for a while because they probably issued a bunch of stock options to their employees after the stock ran up during the clown market. But overall, I mean, they have positive operating cash flow, but it's not like growing massively, okay? Like you could look at free cash flow, but sometimes obviously businesses are investing. So they're going to be spending money on capital expenditures. But even the operating cash flow, the core cash flows of the business, they're not doing that well. I mean, it's not like mind-blowing operating cash flow growth. Let's see. Yeah, I don't know. I'm just not impressed with this company. Let's see. They've been issuing some shares, nothing crazy. They took on a bunch of debt in 2020. Interesting. And yeah. So overall, like I don't understand. Like, okay, it has revenue growth. It just loses money. Let's go look through the shareholder deck. Okay, this is the most recent earnings. So what they were shilling was the massive growth in their total monthly active users. So you can see they've had pretty impressive growth in their monthly active users. They're growing pretty well in that department. So you can see their monthly active users increased by 22% year over year. And as of Q1 2023, they had 515 million monthly active users. That's a lot of people. Now, of those, about 40% are premium paying subscriptions, and 60% of those are ad-supported. Now, you're going to see the vast majority of their money comes from subscriptions. So what you're hoping is these ad-supported monthly active users that downloaded the app and use it every once in a while, you're hoping they convert to premium users because that's where all their money comes from. If all those people converted to premium users, they would make a lot of revenue. Okay, that's all I'm saying. But, okay, let's see. Financials. So you can see revenue from premium is basically all of their revenue. It looks like 90% of their revenue comes from premium subscriptions where you subscribe, you pay $8 a month, $9 a month, whatever it is. And then AARP. And then the rest is ad supported. So, you know, they have for the free version, the app probably I don't use it, so I don't really know, but they probably have like ads on there and there's certain limitations. But ad supported revenue looks like it's going down quarter over quarter, but it's up year over year, and premium's up year over year, 14%. So their user base is growing faster than their revenue. Interesting. So their revenue per monthly active user is going down. Their gross profit has been very consistent, 25%. And they continue to lose money repeatedly. And they have very, I would say, anemic cash flow from operations. I don't know, man. Like, what is so special about this business? Like, I'm serious. Is it Joe Rogan? I wonder how much Joe Rogan cost them. Are they even making a profit on Joe Rogan? So let's see. Try to see if there's anything else interesting on here. They had a couple interesting charts. Revenue by revenue, premium gross profit. Okay. Yeah, they're losing money on ads. Basically, the whole ad tier there is there to convert people. It's not a profit center, it looks like, because they have a negative gross margin. So all their money comes from premium. Makes total sense. Let's see.
Free cash flow.
Here we go. Monthly active users. So they're definitely a global brand. I mean, you got 30% of users are in Europa, 20% are in North America, 21% are in Latin America, and 28% is in the rest of the world. It looks like most of the growth is coming from rest of the world. That's what it looks like. You know, it looks like, I mean, Europe definitely grew a little bit. North America growth almost looks like flat. And Latin America looks maybe a little bit bigger. Most of their growth has come from the rest of the world, which I don't know how good I don't know how much, I don't know if they charge different rates for people internationally. But you can obviously see that most of the growth is coming from the rest of the world. And premium subscriber growth, it's basically, okay, so it seems like the rest of the world, they're not really signing up. They're not really converting that many people. It seems like most of the growth is actually coming from Europa. Okay. Interesting. Let's see. Hi, blah, 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 blah. Okay. So, I mean, that's it. It's a streaming platform, and you can listen to music and podcasts. Wow. Here's Miley Cyrus. Disgusting. Their outlook for Q2, they're going to have 530 million users with 217 premium subscribers and a gross profit of no change. And they're projecting an operating loss again. Just lose money. They just lose money and lose money and lose money and lose money. So you can see, you know, the vast majority of their user base is ad supported and they make almost no money. So if they have trouble converting those people, they're not going to do that well. Okay. They're going to continue to lose money. So if we go to their financial report, I just want to look at their balance sheet real quick. See if there's any warning signs here. All right. Cash looks fine. What? Wait, hold on. That doesn't count. What is this? Why do they have non-current assets first? I think they're a Swedish company or something. This is such a clown. What is this balance sheet? Why would you list non-current assets first? Okay. Anyway, so leases no change. PP&E went down a little bit, probably depreciation. Goodwill went down a little bit. Could be like a tiny impairment, or it could be foreign exchange or translation. Long-term investments is stable. Basically, their long-term assets stayed exactly the same over the last 3 months. Their current assets, I don't see any massive changes here. So they have total current assets of 4.2 billion euros, and they have current liabilities of 3.4 billion euros. And yeah, so they're probably not going to go bankrupt anytime soon. And they don't have a ton of long-term debt. So I don't see this company going out of business anytime soon. I think they're going to be fine, especially if they have positive operating cash flow. Let's see. Total. I don't like this balance sheet. What is this? Let's see. See, the equity's on what? Okay, for their equity, so they had growth in share capital. They had they didn't buy back any stock. Other reserves, what is that? An accumulated deficit. So basically all their equity is coming from stock issuance. Wow, because they don't make any profits. What an amazing company. Would I recommend you buy this? Well, you buy whatever you want, okay? But if I could buy a total world index fund as opposed to buying Stonkify, where there's 100,000 different competitors, I'd probably go with the total world stock market index fund, okay? That's just my personal opinion. But you know what? The stock went up a lot recently. Let's look at the last year to date. It's up 92%. Just buy the stock, bro. Let's look at the long-term chart. Looks kind of like ARK. So that's that. I'm honestly not a fan of Spotify, even though I use it. So I guess I'm just a massive hypocrite loser. All right, let's do some comments. Let's see. Hello, Strongman. Hello, sir. Spotify is a joke company. I hate Spotify. I use SiriusXM. I use Spotify, obviously. Be nice to Spotify. It's going to 5K per share. Oh my. Is this the next AMC? Joe Rogan and Hannah Gatsby are the only comedians to never tell a joke. Not going to lie, but it was a good price at $80. Maybe. Only the long run will tell. It seems to be similar to Netflix, where they weren't profitable. I expected to be seeing growth with an expectation to be profitable. But, like, I mean, Netflix, I'm not a fan of Netflix either. Like, I don't know what's so special about Spotify. I really don't. I don't understand why it's so different. It's so much better. And, you know, you should buy the company when it doesn't really have a moat. It just doesn't seem like it does. I believe it's all about seeing growth. Well, yeah, that's all growth investing. You're just like guessing the future. Music platform out of all of them. Their edge, I believe, is that they have video as well and exclusive podcasters. But I mean, every other podcasting platform could add that. Like, that's not like a hard thing to add. Spotify is facing competition from Google, Amazon. Exactly. That's my point. You're fat. Okay. All right, guys. That's Stunkify. Watch it go up 20,000% after I make this video. I don't really care. I'm still buying VT. Talk to you later. Cheers.